This conference will now be recorded.
Hi everyone, it's Patrick, the damage principal. It's how to trade effects and my position. And we got Beat in the house. Hi Beat.
Hi Patrick, how are you?
I'm very well, thank you. Very well. It's been a great week, and yeah, a bit of up and a bit of down, and yeah, we've got some good topics today. It's yeah, just overall, I think trying to get short risk on rallies gave me a bit of pain, but I think that was my own fault. But I think, I think we've certainly spoken about this before offline, and I think I blogged something. It's not about dollar long, dollar short. It's about risk on, risk off, and maybe playing the short side of those fading those risk on rallies. Is that still the case for you, mate?
Yeah.
How are your thoughts?
Yeah, to be honest, it took me probably nearly 2 weeks to just watch equities in terms of trying to sort of just figure out whether this is just a sort of fluke sell-off and followed by, strong rallies like we had more or less most of 2018. But I just sort of noticed that, the pattern seems to have changed from, dip buy to rally sell. Every time you had a decent rally in equities, and speaking mainly of US equities, you just could start to feel how the sellers just line up. And the other thing I noticed that, by most of 2018, we had, let's say, if Europe would sort of sell the futures, the moment Wall Street opened, stocks were just ranked higher. And now, actually, it's the other way around. Sometimes you like small up, Wall Street opens, bang, we start to sell off. So clearly, whether someone is bearish, bullish, whatever, fact is the pattern has changed. And to me, it's a pattern of seller rally. So sort of from mid last week, my conviction of lower equities has really hit the highs, and that's when I sort of started selling the classical ones, the Aussie yens, the Euro yens. And like we discussed during the week, I'm only buying dollars that benefit from risk off. So I think the dollar focus, the dollar story, as in euro dollar lower or whatever, I think is over. Whether the euro goes down or not, who knows? So euro dollar and dollar yen are hit and run pairs for me. If dollar yen rallies on higher yields and we get to a resistance, I sell it for a risk off. If it comes off, I probably just cover it. Euro dollar the same. I sell it on key levels on resistance.
Hello, Beat. I think I've lost you there, Beat, but I'll carry on anyway. I think what Beat was trying to say is, equities are the key focus, and at the moment I agree with what you're saying, Beat. I can't actually see you or hear you, but maybe you log on and off. But equities are the key focus, and I think 10-year yields in the US are probably equities are taking note of those, and we'll see how we go, really. But yeah, I think we just lost Beat, but I'll carry on. But I think obviously, certainly the last couple of weeks, equities have taken notice of 10-year yields, and we spiked above 3%. We stayed above. We touched 3.2, I think it was, and then, and also 30 years doing it as well. So I think that is pretty much going to be here to stay. And also, actually, you know what? I'm going to stop this.
This conference will now be recorded.
So we're back. We had a bit of a technical issue our end, but Beat's back. Hello, Beat.
Yeah,
I lost you there, mate.
Not sure what.
I was all on my own talking about risk off and on, and I was lost at sea without a ding. So
Yeah,
I'm glad
so, so basically, you know, like I just said, so it's a traditional risk-off crosses I'm building up. Euro dollar and dollar yen are for me the sort of no-go areas where I just think, you know, you trade it. They're like sort of trading currencies for me now, not position currencies, because euro dollar has no clear risk-on, risk-off pattern. Dollar yen, I think, as you remember, I haven't trusted it more or less most of 2018 because this constant fight between equities or channel risk off versus US yields is just, it hasn't led dollar yen anywhere really. And I think, you know, if you get a proper risk off, then I think dollar yen is at risk of sort of going down to the 108, 107 area, which I think is actually where I think euro yen is going. So euro yen, I think, is the one that's going to push dollar yen down. It may take part, you know, maybe euro has a step lower in it as well if that happens, but that I'm not really betting much on it. I'm much rather short euro yen. The one question that's probably open is, you know, yes, I'm very convinced we're going to get risk off. Yes, I'm very convinced US equities start to go down. The only thing I'm not yet sure, and we might never be, is if you're going to get a fast move or a grinding move down. I think that will depend how risk currencies behave, or how, you know, if they just grind lower and, you know, people get bored at some point, or if actually at some point we're going to have a real sort of gap lower in equities, which then gives us the sort of gap lower in risk, like Aussie yen, euro yen, so the market actually really starts to get on the case, get focused on it. Right now, it's kind of a small mix of a little bit of everything. But
yeah,
generally, high conviction that equities have peaked and are gonna get, you know, marked quite significantly lower in the next sort of 6 to 12 months.
yeah, I think so, and I think the turning point for me was when the S&P started looking at 10-year yields, and before this, it was just oh, you got paused on your screen.
Yeah.
Are you? Can you hear me? Yeah.
Yeah. Okay. Yeah.
I
I
think
tried to press some buttons to get your picture back because I like
Ah,
you, but
ah,
you
I
know,
don't want to crack
no,
your
no,
screen.
I stopped touching it now.
Yeah, it's a technology. Sorry, it's my face. I've got a good face for radio. That's what my best mate told me. And so I think for me the big thing is this risk off. What could be a part of a massive risk off move. It really started to take note on my radar when the S&P was looking at yields and taking notice,
Yeah.
because previously, you know, the S&P was an absolute, like, yeah, rallying, and then, you know, we got the vol complex blow in February, still recovered. Everyone was thought, that's it, the vol genie's out of the bottle. We're going to get new lower lows. It's just going to be all carnage. And then guess what? We're just rallying again. And I just think now, because 10-year broke above 3 and stayed above on the weekly, and, you know, we cracked 3.2, and that was a key level as well. 30 years getting lifted, short ends getting lifted. So it's all kind of happening, and eventually equities are starting to take notice. Now, the only respite was the 2-month misses on CPI, because if they had been beats, it could be a different story on equities lower. And I just think that is now here to stay.
Yeah, I think the other thing to take note is that we have lost the Fed put for equities. Powell seems to just carry on what he thinks is needed based on the data. It looks like the Fed we have at the moment is the first Fed in a long time that is truly data dependent. So whatever the data is going to be doing in the future is what Powell is going to do. So he's not going to look at equities and go like, oh, you know, let's talk a little bit of dovish, the way Yellen and Bernanke did. So I think this is something not to be underestimated, because for the last, God knows, 7, 8, no, more than 10 years, we could always sort of bet on the Fed that whenever things get a little bit, tricky, the Fed would go off the pedal a little bit, talk a little bit dovish, maybe delay a hike for a month or 2 or 3, whatever it was necessary. The same is for emerging markets. Yes, Powell takes note of it, but he seems not to think that it's the Fed's responsibility to, if dollar EM suddenly gets a bit too high, that the Fed should start to pause or delay any future hikes. So once this is fully understood, which it may not yet be, I think, and the equities start to sort of come off, I think there could be the moment where people really go, oh, even now, if you go down another few percent and there's still no signal from the Fed that, some dovish speakers or whatever, that could really be the moment where the market starts to actually realize, oh, the Fed put is gone for the first time in over 10 years. And that could actually help the move lower. So personally, I think Powell doesn't, I don't want to say he doesn't care. He just has a job to do. And he goes like, you know what, equities, he himself said that equities,
That's right.
He didn't quite say they're rich, but more or less, it's what he said. So he has no concern if equity is correct, 10, 15%, as long as it's not like a bloodbath and crazy. But so I think that's what the equity market will have to realize. There is no Fed put. And I think that's another reason that makes me more convinced that this time is the real one.
Yeah, absolutely right. And, I think he has telegraphed it in not the right words I'm going to say, but he's not going to prop up equities. It's not his job.
No.
It's not in the mandate, really. Jobs and stability are the two key things that the Fed's mandate is, and unless it really goes pear-shaped, if this whole EM, there's some proper carnage in EM and it feeds back into the S&P and that feeds back into everything else, and it all goes exactly.
But then again, you could argue it's data watch. The moment you see consumer confidence suddenly start to come off, because that's probably the first one to come off when things start to really go pear-shaped, and there he has his reason to maybe start to soften the stance. So it's going to be interesting to see. But so far, he looks like a man on a mission. Plot, the plot plan is there. 1 hike in December, 3 more 2019. The only thing which I figured out on my cheat sheet from the FOMC, when I look at who is falling out into 2019. So if you look at the sort of hawk-dove balance, is actually in 2019 we have a small shift to the dovish side. So we're losing Mester, which is the second biggest hawk. We losing the Barkin, Richmond Fed, who has been more on the stronger hawk side. And
they're all voters, are they?
They're all on the hawkish side. We lose them for 2019, and they are replaced by Evans, who is more of a dove. It's replaced by Bullard, who is one of the most dovish, St. Louis Fed. So 2019 will see a shift to the dovish side of the Fed. Whether, even the doves have sort of agreed to the dot plan. So, that means the 3 hikes for 2019 is not suddenly to be questioned, but it's not suddenly going to be 4 unless the data is just screaming. If you get like a lot of data surprises on the upside. If not, then it's definitely going to be the 3. Unless data shifts to the downside, we could suddenly be in a position next year where we go down to 2. But, that's future. I just want to say, once a deck hike is out of the way, the balance of the Fed shifts to a more dovish Fed from a more hawkish Fed in 2018. Just something maybe to note, which is not going to make a difference today, but it just, even we slowly get to the end of 2018, there's maybe just something to keep in mind.
Yeah, good point. Very good point. And it's always you know, something I sense check every month. I look at the US macro picture, and you know, 2 months ago it was smoking hot,
Yeah,
smoking hot. A month ago it was largely pristine. Now it's pretty good. Actually,
yeah,
it's still very good. I mean, yeah, jobs fine, unemployment's 4%, well below Nauru. Wages actually very good, 0.2 higher last month, pretty good. CPI's come off a lot, but you know, if you're talking about Goldilocks at 2%, we're at 2.3, I think. I mean, it's no horror show. GDP 4.1 last time. It's great. I mean, so it's got to be something pretty significant to alter that macro
yeah.
picture. And
To be
I
honest, I
always
think
ask,
the dollar would have probably had a window where it would have weakened on the two CPI misses if the news in Europe would have been better and not
yeah,
had a lot of GDP downward revisions across many European countries. We had a CPI miss in Europe as well. So I think
yeah,
without that, I think Euro could have quickly had a 2-3% correction so that the dollar picture gets just a bit of a correction after the CPI misses in the US. But because the news in Europe got weaker at the same time, that's, I
mm,
think, why the dollar sort of just survived and didn't go anywhere, really.
mm. Yeah, I agree. Cool. So we've got our next topic, dollar CNY 7 update. So far so good on capping that. I just get a sense of, you know, there's a point where if yields do take another leg higher, and you know the data's just still delivering, you know, there is a sense that at some point that's going to break. But I wouldn't be a betting man to tell you when. So,
No,
what are your thoughts? What's last week telling
to
you?
be honest, it was quite obvious, even though that I think few market commentators, in my opinion, got the point wrong when the US Treasury report came out, when China wasn't named an FX manipulator. We had a move higher in dollar CNH immediately, which some market commentators took as the PBOC allowing the CNH a weaken just a day or on the same day that they weren't named FX manipulator. I actually
Okay.
think it was the market doing that. It wasn't PBOC. PBOC was actually the ones. It was like, watch it that day. It was while the dollar weakened across the board somewhat that day. Dollar CNH got bought like crazy all day long at 695. I mean, it's 693 now. So to me, actually, PBOC was a seller at 695 quite aggressively, and you know my opinion. And to
Yeah.
be honest,
Oh, I think we lost Beat for a bit. Just following up from what Beat was saying, dollar CNY 7 is a huge level. It still gets sold into. It's absolutely, you know, if that does break, you can see probably euro dollar going south below 113. So I think that's probably enough covered on dollar CNY CNH. We're probably moving on now to dollar SAR. I think, you know, this doesn't move that much because it's completely pegged with the Saudi guy getting killed. We both Beat and myself have been looking at forwards. These have calmed down really. So the key thing here is Trump. He's accepted the explanation from Saudi. Basically, he's accepted it. So I think that's just, unfortunately, not really a story anymore. Let's just see. Let's just see what happens.
I am again.
Hi, Beats. You're
I'm
back.
not sure what's going on today. To be honest, it's the second time the Wi-Fi. I'm not sure if the sunshine didn't do him any good or
Yeah,
no,
no
silent
worries.
problem.
we're still online. I was just wrapping up a bit of the dollar CNH CNY whatever, and the consequences of a 7 breaking, EM
Yeah.
carnage, dollar much higher, euro dollar breaking 113, the big fig, probably almost undoubtedly, and but we don't really see that happening.
No, not at this point. Not if they can avoid it, no chance.
So I was just talking about dollar SAR, and the fact now that Trump has accepted the explanation from the Saudis in his death. It was two intelligence officers involved. It was a fight, and they remain allies.
To be honest, too much money at stake, I guess.
Well, it's at arms, isn't it?
I mean, it like we all know, it stinks, but I think the only good thing that could come from it will make the crown prince somewhat a little bit more careful. That he just, they had this big Davos of the desert last week.
No one turned up.
No one turned up. Definitely none of the heavyweights turned up. And that's just an embarrassment for Saudi Arabia, because the projects they're looking at is really making Dubai like a kindergarten. It's huge, and that's why no one has. This is not just the oil or the weapon. It's what he plans to do in Saudi Arabia is beyond belief in terms of construction, and the amount of contracts that would go to the West is just beyond. And so I think everyone is just trying to believe that story, even though everyone knows it's not true. I mean, the Saudi forwards have moved a little bit to the right last week, but minor. No one really. And I think if this doesn't escalate from here on, especially with the US, I think it's just going to die down. So we can probably take it off the radar for now.
Yeah, I think so. Just quickly, I spoke to a friend today for coffee, and she ran a Dems campaign, and she's kind of clued up. But it'd be interesting to see your thoughts. It's about the midterms. So I ran through some of the scenarios we spoke about last week, and she was kind of filling me in a bit on the process of an impeachment and what she thinks, which she wasn't 100% sure on, is to take majority is more than 51%, but to actually to kick off or to instigate an impeachment, it's got to be 2/3 or something. So I just think if Trump gets both houses lost, if the Dems take over, it still will be not a straightforward process. But that said, I think if it's announced, that'll be enough for a risk off, because that's not, you know what I mean?
I think the market, rightly or wrongly, will probably, like you say, just look at it like, impeachment's going to be launched, chance for him to actually lose. I don't think that people, it's a good point you made. I'm going to read after we finish the call to see what exactly the sort of law of Congress says in terms of how much votes you actually need, if it's simple majority, or like you say, if it needs a 3/4 majority. What would surprise me about the 3/4 majority would be, not that I can remember the balance of power during the Clinton years, but during the Clinton years, we discussed that last week, there was a motion of impeachment going to the Senate from Congress. And I would be surprised if the Dems or the Republicans did hold 3/4 of the Congress. And I couldn't see Democrats voting to impeach their own president. So I would have to do a little history lesson briefly to actually see. But overall, I agree. Like we discussed last week, lose Congress, no big deal. So lose Congress, keep Senate. It's, certain stuff is going to get harder. Some stuff Trump wants to do, but he's going to sit firm in the seat. No risk for Trump. If he wins both houses, that would be almost a surprise. That would be a big boost to him, and he would just probably set out a few more things he wants to do. And you know what? This could actually mean his re-election in 2 years' time.
Yeah.
If it would be a first time in a long time that a president, an acting president, especially one that is so controversial, would actually not lose at least one house in the midterm, trying to give a bit of a balance. So I think the center case the market will look at is, yes, he's going to probably lose Congress. He's going to keep the Senate. Yes, things get a bit tougher to pass through, but end of the day, not much is going to change. As I say, if he would lose both, it's a real storm starting right there, right that night. Before it then sort of settles when people want to see, okay, what happens next? So I think you get a big move down in equities, big move down in the dollar, and then we probably stay put until we actually start to understand, okay, what is the procedure, how long it's going to take, blah, 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 blah. Then we go to the real true reasons or the true protocol of an impeachment. For those that maybe don't know, impeachment process is not a legal process. It's a pure political process. And the Senate has the final word. And that's why if Trump keeps the Senate, obviously no one is going to vote to impeach Trump. So that's why he's not going to, be impeached if he keeps the Senate. Just maybe to fill in the blanks there. So, but it's going to be a night that I will spend in front of the screens. It's one of these exciting, few nights in the market, and I can't wait, to be honest.
Absolutely. That's fantastic. So finally, we're just going to give you a little insight on a little bit of, tell you about Tuesday night. So we got Making Sense of Macro 90-minute session with myself. Beat's going to be there, and it's just to give you a little taste of, the basics of macro, what we look at, how to trade it, keeping it really simple, because you can get, I certainly got quite confused when I first started understanding macro, and if you stick by some very basic rules, you can't really go far wrong. And there's a lot of noise out there, a lot of fancy words, and a lot of it is very, very important, but a lot of it is some of it is not needed. It's just not necessary. So we're going to be doing that. If you want to know more, message me. Tickets are £25 and food and drinks included. We'll also be giving you details of our masterclass, which is the second masterclass we've done, and that's on the 7th of November. Like I say, just let me know, and we'll give you more details on that. The only other thing I want to tell you about is Beat's amazing daily commentary, which is absolute gold dust. Over to you.
Thanks, Patrick. Yeah, I'm sort of doing like the charts and a little bit research stuff every morning in the sort of majors or whatever the theme is. I have a second sort of email group which is probably helpful for those that are not yet probably full professional traders, which explain some of the news that's out there, stuff I'm watching. So it's almost like a little bit of a live environment of what I do with the news. And if someone wants to know more, just message Patrick or myself, and I tell you more about it.
That's fantastic. And the only other thing is next week we've got Bank of Canada rates, the big one, the European rate decision, and there is obviously, Italy's not going anywhere, not going away anywhere too soon. Carney's talking on Tuesday, but it's about artificial intelligence in Toronto. PMI's on Wednesday in Europe, but I think that's pretty much it. But I think I agree with Beat. He said something to me the other about a week ago about the Aussie dollar being the best long on dollar, which I still kind of am, but I see it's more of a risk play, and certainly I think you do too, Beat. As you mentioned before, it's because of equities and the way they're looking vulnerable. FANGs are looking very, very ropey. Facebook in particular, and Amazon as well. Just the way that price action is looking, I particularly like selling into risk on rallies. So look at yen pairs. For those who have the appetite, look at Swiss pairs, or my thoughts on Swiss, but look at yen pairs and watch that risk. Just be careful. All right. But thanks very much this week, Beat, and
thanks a lot.
Take care and see you next week.
See you next week. Take care. Bye bye.
Bye now.